blockchain digital assets industry. Prior to joining Kaiko, she spent a decade at HSBC in London and Paris structuring equity derivatives and equity-based financing solutions. She has a passion for world-changing technology and has been interested in digital assets since 2012. She was elected as a member of the scientific committee and board of the foundation of at Concord, a renowned French think tank, and is leading a working group on blockchain-based transformations of European capital markets. Please put your virtual hands together for the leader of Kaiko and our friend, Ambre Soubiran. Welcome.
Thank you so much. Thanks for having me, and thanks, Chris, for the brilliant intro. I'm delighted to be here. And is this the moment where I present my screen?
This is the moment that you take it away. It is all your stage now, your virtual stage. We look forward to your presentation.
Perfect. Thank you very much. All right. So hello, everyone. Thanks for being here. And I'll be presenting the slides. While I present the slides, I do not see the Q&A panel. So I will try to finish a couple of minutes early so that I can check if there's any questions and address those. So we're here today to talk about how order book data is interesting to measure liquidity across crypto markets. It's relatively technical. I'll try to be as clear as possible, but feel free to ask, of course, if you have any questions. So first of all, in short about Kaiko, so we've been around since 2014. We are a market data provider. We are meaning that we're basically connected to all cryptocurrency exchanges out there. We're talking over 85 exchanges. And we gather market data, meaning trade data and order book data across all traded instruments that are listed on those exchanges. So we collect the data, we standardize this data, we make it indexable and searchable and easily accessible in data repositories, and then we distribute this data through our own set of APIs. We're based in Paris and we have offices in New York and in Tokyo. So here, in short, is what we do. We're connected to about 100 exchanges now. We have a big stack that actually takes the data, deduplicates it, stores it, indexes it, does aggregations, creates a bunch of derivatives and analytics, creates flat files, and then re-exposes this data through a different set of data products. We have a data feed. This is a flat file system, a market data API, which is a bit like your exchange API, but you can access every single exchange through ours, and a WebSocket, which is used for streaming real-time trades. So high level, this is what we do. We're really providing the infrastructure for anyone in the crypto industry to access in a relatively seamless fashion any type of market data. So that's what we do. And here I want to focus on order book data. So the two main types of data that we get from exchanges are order book data, meaning all the bids and asks that are being placed across the different markets, all the buy orders and all the sell orders. This constitutes the depth and the structure of the market for any given instrument. So for Bitcoin dollar, you will have different price levels at which there are different people willing to buy specific amount of cryptocurrencies, and this constitutes the order book. That's one of the information we collect. And the other information we collect is executed trades. So when the order book, when the matching engine of the exchanges matches a buy order with a sell order, that creates a trade. And this is how price formation happens in the crypto markets. This is also an information that we get. Price is a very straightforward item, and it's very easy to understand that, you know, if there was a trade that took place where someone was willing to pay 11,000 US dollars for a Bitcoin, then thereby this is the price of Bitcoin. It's quite straightforward. However, order book data, which is really the depth and the structure of the market, is sometimes a little bit more abstract and a little bit more cumbersome to handle when you are an active market participant. However, they are actually very important in defining the structure of the markets and the depth of the markets, and they give very important insights on the actual liquidity of any given asset. So we talk about traded volume. Very often we look at what was the daily traded volume of any given crypto, but we forget to study liquidity. So here, the way we define liquidity is the degree to which an asset can be quickly bought or sold on a marketplace at stable prices. The key word here is stable prices. The more an asset is liquid, the more its price will be stable. So when you're only looking at trade volume as an indicator of liquidity, we ignore a crucial aspect of this concept, which is the price stability. And order book data, which is again the depth and the structure of the market that represents really the demand on the buy side and on the sell side, allows us to study the effects of market orders on the price of an asset. If there is very little demand and you want to sell a crypto asset, but there is little demand to buy, you are going to have to devaluate your assets for the buyers to actually start getting interested. So that will effectively have a significant impact on the price of the assets. So here we are going to look at a couple of metrics that give a very good proxy to liquidity. The three metrics I wanted to introduce here is market depth, price slippage, and bid-ask spread. So the market depth is really the quantity of bids and asks that are placed on an order books by the quantity of bids and asks, and I'm going to show graphical representations of this in the next slide. We're talking about what is the volume of Bitcoins or Ethereum or any different crypto asset that is currently outstanding, placed on the buy side and on the sell side. Obviously, the deeper the market, the more volume there is outstanding on order book, generally the more liquid the market is. The second metric is price slippage. Price slippage is the price difference between the expected price of your trade, which if you naively look at the mid price of the order book, let's say that it's 11,000 US dollars for Bitcoin, you can assume that the price of Bitcoin is 11,000 US dollars. However, if you want to buy 10 or 20 or 1,000 Bitcoins, you will have an impact which is called price slippage, which means that you have to actually dig a little bit into the ask side or the bid side in order to fill in your entire volume. That resulting change in price is called the slippage. So generally, the lower the slippage is, the more efficient the market is, the more liquid the trading is. I will also show slides to illustrate this. But just in short, the price slippage is the difference between the expected price of a trade and the price at which it is finally executed. That is, ties very much to price stability that I've mentioned earlier. The bigger the slippage, the less stable the price, the less liquid the market. And then finally, the bid-ask spread. The bid-ask spread is very straightforward. It's the difference between the highest price that a buyer is willing to pay for any asset and the lowest price a seller is willing to accept for it. And obviously, if there is a very wide spread, the market is deemed to be less liquid. And if you have a narrower spread, it has an impact, obviously, on price slippage as well. The narrower the spread, the more liquid the market. So all of these are very tied to each other, but are three very distinct and very interesting indicators to watch when you're interested in crypto assets liquidity. So here is just a representation of market depth across different exchanges. So you can see Gemini, Coinbase, Bitstamp, and Bitfinex, and you can see cumulative market depth for Bitcoin dollar over a period of a week earlier this year. Here you can also see that we have charted the average price of Bitcoin over those markets during the same time period. And you can see that when there is a significant change in the price, you could see that market depth has been quite significantly consumed and depleted. So market depth is impacted as the volume is being consumed, and then obviously there's new buyers and sellers that come in and refill the markets. Here, what we look at is the bid depth versus the ask depth. So you can see here that this is the volume on the ask side on the red cell, and the volume on the bid side is the green cell. So here you can see that there is an imbalance on the order book, and that is very correlated to the price effect. So here there was a very sharp increase in the price that has depleted the bid volume that was outstanding on the order book. This is Coinbase Bitcoin dollar. So on May 19th, the price of Bitcoin jumped over a very short time interval, and then it corrected again. And as the price rose, you could see that there is a divergence between the amounts of people that wanted to buy and the amounts that people wanted to sell. And so this is the behavior of the market participants. And as the market was rising, obviously there were more and more ask volume that was placed on the order to keep up with the influx of newly placed buy orders. Here is an interesting thing is the charts of the market depth on Coinbase Bitcoin dollar during the price crash of March 12th, when the COVID crisis started and pretty much every market out there completely crashed. Here you can see that there was a selling pressure and that there was a very rapid depletion of the volume that was outstanding on markets, and then it built up again. So market depth did take a bit of time. We're talking between here it was 10:45 a.m. and here it was 12. So we're talking a couple of hours, actually less. Let's say it took about half an hour for the market to start repleting again, and then it became back to almost initial level after a day. So here, this is to give you notions of market depth. So the depth, again, is the volume that is placed across markets. Here we're looking at price slippage. So as I said, price slippage is calculated, it's based on the order book data and it's tightly correlated to the structure and the depth of orders on an order book. So very correlated. But here we define it as the kind of consequence on your execution price compared to the initial mid price that you expected. So price slippage can be simulated for any order size. Here we have charted it for a 50,000 US sell order, but it could be done for any order given size. And we've done it on a couple of exchanges, which also can be done on any given markets. So here you can see that slippage on Bitcoin dollar is generally somewhere between 1 to 10 bips. And that it crosses over a lot, across different exchanges. So this is a metric. It's interesting to monitor this metric to know where you're going to execute your trade. Sometimes it's not just a question of price; it's also a question of slippage and what is going to be the impact of the market of the order book structure on your execution price. Here we can see price slippage for different order sizes. So you could see that the lower the slippage, the lower the order size, which makes sense because you are less impacting the market with a small order than you are with a large order. And thereby a large order will have to consume more of the order book and in effect result into a higher slippage. So obviously when you have large market orders, they can push the price of an asset up or down by eating through the bids and asks on an order book. On a very efficient market, order books will, be adjusted in real time and there would be a smooth correction. But when you are on less liquid markets, the slippage may be quite sharp in increase. This is just to show the slippage on altcoin markets compared to Bitcoin. You can see that here below the line here is Bitcoin market, which is a much more liquid market than all the altcoin here. So we've looked at the Binance Coin, EOS, TRX, and XRP. And this is just to show that slippage is an indicator of an asset's liquidity. And we can see here that Bitcoin is a much more liquid asset than some of the still relatively large altcoins out there. All right. And finally, I wanted to take a look at bid-ask spreads. So here, spreads are an indicator of a trading pair liquidity. The narrower the spread, the more liquid the asset. If you compare the tighter, narrower spread exchanges with their market depth and with their price slippage, you could see a clear correlation between those three. So here we've charted spreads for a couple of different assets on a couple of exchanges. And here, what we've charted just to show the correlation is the correlation of the here bid-ask spread on Coinbase versus the trade volume. So you can see that in general, when there are spikes in volumes, there are also impacts on the bid-ask spread. Same thing on the derivatives market. You can observe the exact same behavior, where you can see that derivatives contracts that are closer to expiry are more liquid, they are more traded, and thereby they have thinner spreads. So you can see here, this was done in May, and this is the blue line, which is the narrower spread. The lower spread is the contract that has the closest expiry, and the December expiry trades at a higher spread. And you can compare it here with the volume traded. The contract that was closest to expiry had a much higher volume, and the lowest traded volume was the one that expired in December. So here, just one thing to kind of close on those three metrics and why we believe that order book liquidity is very important. Order book liquidity creates healthy markets, and it enables better market-based price discovery. It enables better price stability. And when you have some price crashes, we can see how any kind of market event can have a consequence on the order book, on the prices, and that can be exacerbated in some kind of loop, of vicious circle, or however we want to call it, where you have initially a market impact that triggers sell prices, that triggers sell orders, that then triggers a crash. And so there's a continued sell pressure that triggers automatic liquidation. And then you have more liquid and more selling pressure. Order book actually starts getting decimated, and there is less liquidity on the exchange, and then prices reach a bottom. So there's a very strong correlation between an order book's liquidity, an order book structure, the effect it has on price, and the matching trades that are executed by the matching engine. So just one thing, if anyone here is interested in getting order book data, all of the metrics that we have presented are absolutely available, and feel free to reach out if you have any questions or of anything that I said. I still have 2 minutes for questions, so I'm going to jump to the Q&A now. But if there's anything specific you want to discuss, feel free to reach out. Here is our contact detail, and every metric that I've showcased is available for every instrument that we cover. So feel free to reach out. And I will go into the question section now. Wonderful, no question. So I guess either I was crystal clear or I was very, very obscure. But regardless of that, it's 13:09, so I'm up in 30 seconds. So thank you everybody for listening to that, and don't hesitate to reach out if you have any question in the future.